Tēnā koutou katoa. As is customary in Aotearoa, we're going to start with an opening karakia just to help set the intention and create a safe space for the conversation. So the one that I've selected today is about unity, it's about vitality and well-being. So, me noi tātou. Tūtaua mai I runga, tūtaua mai I raro, tūtaua mai I roto, tūtaua mai I waho. Kia tau ai te mauritu, te mauri ora ki te katoa. Haumi e, hui e, pai ki e. That means come forth from above, below, within, and from the environment. Vitality and well-being for all, strengthened in unity, which I thought was relevant to the conversation today. We also start with a small mihi, which is some acknowledgements. So tēnei te paku mihi, ki ngā tini mate o te wā kua mene atu ki te pō. Haere koutou, oki oki atu ai. Ki ngā rangatia, kua tū ki te hui whakahirehire nei, tēnā koutou. Ki ngā manuwhiri, kua tai mai mā te hui topa, ngā mihi nui ki a koutou. Nō reira, tēnā rā koutou katoa. Which means first the acknowledgements to those who have passed on before us, to rest in peace. I know that is relevant to some today. To the rangatira, to the leaders here that are joining us for this important webinar and topic. And to you all, our guests who are joining via Zoom. Ngā mihi nui to you all. So, over to you, Ruben.
Thank you, Bobby, for the warm welcome. And kia ora and welcome to our webinar on navigating the Aotearoa New Zealand climate standards. My name is Ruben Langbroek. I'm head of Asia Pacific for GRESB. And today we'll have, I think, a quite exciting webinar for you in Pedo. We'll bring you some very valuable insights in terms of how real estate as well as infrastructure companies can navigate climate-related disclosures, especially when they relate to regulations. But we'll also highlight some of the opportunities that climate-related risks and disclosures might give to participants around the globe, but specifically New Zealand, in terms of getting access to institutional capital that drives the transition to climate resilience as well as net zero. As you can see, the agenda for today's session is currently up on the screen. And we'll hear from the various speakers why climate-related disclosures are so relevant and especially important to the real asset sector. We'll also have a very undoubtedly engaging and insightful panel session at the end of the session, during which we'll highlight the different perspectives on climate risk, as well as the reporting standards, but also, again, how capital providers can spur positive change in our sector. And of course, as always, this webinar is meant to help you gain those relevant insights so you can better navigate sometimes rough climate seas. So if you have any questions in terms of what's being presented on today, and especially to the panel session, please feel free to submit your questions in the chat function at the bottom of your screen. Hopefully we're able to address all of your questions, but if not, we'll definitely follow up with them after the webinar. And then as a last housekeeping announcement, we have started the recording of this session. So we'll share the link of the recording to you after the session. And if you're interested to hear anything that you've heard today, again, then you can do so by following the link, which will provide you to the on-demand recording. Now let's get into business and climate disclosures. I'll very briefly would like to present on GRESB for those of you that are not familiar with GRESB, but also how it relates to both climate risk as well as climate reporting. So again, for those of you that don't know GRESB, we are a mission-driven and investor-led initiative where we provide actual environmental, social, and governance analytics to the real asset sector. And we do this by validating, scoring, and benchmarking real estate and infrastructure companies' alignment with best practices in ESG in line with the so-called GRESB standards. On one hand, it allows investors and lenders to understand how their investment managers or their borrowers align with best practices. And this way they can reward companies that are leading, but at the same time also incentivizing laggards to catch up. And that's important as well, as they need to finance the transition to a net zero, nature positive, and climate resilient sector. But equally important, and perhaps even more importantly, it also allows participating companies and managers that report to GRESB to understand what they're already doing well in terms of ESG practices, but also climate-related practices. It provides them with insights in terms of how they can improve their practices, and potentially also what those improvements look like just by looking at what their peers or competitors in the markets are already doing. So via this, I have to say, globally tried and proven approach, we aim to support the transition and lead to better outcomes for the real estate sector and all stakeholders involved. Now, how the mechanism works in terms of capital provision is that specifically the top-down allocation of mostly institutional capital that is seeking green but also climate resilient investments indeed is creating bottom-up commitment from real estate and infrastructure companies. Commitment in terms of disclosing their ESG and climate practices, but importantly also to improve those practices based on the results of the annual GRESB assessment. And this enables them to deliver more positive environmental, social, but also importantly, financial outcomes. So by using the annual GRESB results, investors as well as lenders can shift their capital to those companies and fund managers that are the most successful at this. And this is important in the context of this webinar because it aligns directly with the main objective of the Aotearoa New Zealand climate standards, which is to support capital allocation towards activities that align with the transition to a low carbon, and I would say net zero, and climate resilient future. Now, how does all of this relate to climate risk and what is climate risk? I guess it's safe to say that nowadays climate change is widely accepted as a financial risk or even financial system risk to the global economy. And specifically because real assets, so think buildings or infrastructure projects, are directly exposed to climate risk, it is not surprising that investors as well as lenders want to understand how these risks are being identified, assessed, and mitigated. And to give you some examples, globally, more than 80% of real asset value and 75% of real estate floor area is at high risk from physical impacts of climate change. And you may think about exposure to tropical storms, sea level rise, flooding, heat waves, and wildfires. So it's a very tangible risk. But at the same time, investors and lenders, the capital providers for our real asset sector, are also very conscious of the risks that arise from the global transition to a low carbon economy. Think of assets that might become stranded because they cannot meet current or future regulations, or for which there will be no buyers like investors or even tenants. This shows that climate risks are very tangible and material risks that can and will adversely impact investment returns if they're not adequately understood and mitigated by the managers. And as a result, there's a growing need from investors and lenders for high quality information on both climate risk exposure, as well as the potential impacts on the real asset investments. As such, by reporting on climate-related risks and opportunities, I would say, investors and lenders can reward companies that have adopted best climate practices, but also they can apply pressure to those that are not. And as such, they are financing the transition to better climate outcomes. How does this then relate to GRESB? We often receive the question that, we now need to comply with mandatory climate disclosures. Why should we, on top of that, also reply to or respond to GRESB as a voluntary standard? Well, it's very clear that indeed disclosures are important, and at the same time there is a convergence of different standards, frameworks, and initiatives. And my colleague Sarah will mention or explain more about the likes of TCFD, IFRS S1 and S2, and other acronyms. But it's important to understand that although the GRESB standards themselves indeed are specific to the real estate and infrastructure sectors, we do seek to alignment with these sector agnostic standards so that GRESB participants can meet regulatory requirements. And interestingly, the real estate industry-based metrics for IFRS S2 are largely based on the GRESB real estate assessment instead of the other way around. Otherwise, importantly, by integrating the GRESB assessments into climate-related disclosure processes, real estate and infrastructure companies and managers can streamline their reporting efforts, consolidate data, and reduce redundancies. And even more importantly, they can gain actionable insights into their operational strengths and identify opportunities for improvement. To give an example, our GRESB TCFD alignment report uses information from the GRESB assessment to assess climate-related practices, processes, and disclosures. And this allows all companies that participate in GRESB to adopt best practices on top of meeting regulatory compliance. And last, GRESB participation offers a great tool for engagement with investors, lenders, tenants, and other key stakeholders by using a widely accepted and used sector-specific reporting standard. So I hope that will have given you a bit of insights into climate risk, GRESB, and the capital markets. There's a whole lot more happening globally, so I would like to pass on the virtual mic to my colleague who's actually sitting next to me, Sarah, our Member Relations Manager for Oceania, who will offer you insights into the global regulation landscape. Sarah, over to you.
Thank you, Ruben. Hi, everyone. It's great to speak with you all today. I am delighted to give you a quick rundown of the global regulatory landscape that has been developed within which the Aotearoa standards sit, before one of our panelists, Lisa, takes us on a bit of a deeper dive. We'll begin with a quick whirlwind tour of the regulatory history from the past 9 years. So the Task Force for Climate-Related Financial Disclosures, or TCFD, was established by the Financial Stability Board in 2015 for 3 main reasons. The idea was to allow investors to benefit from relevant, comparable, and clear and consistent information regarding the financial risks and opportunities of climate change. After developing a framework across 4 pillars of governance, strategy, risk management, and metrics and targets, the TCFD was disbanded in October 2023, following its final status report. This was because it was deemed to have fulfilled its remit, with IFRS taking over the monitoring of companies' climate-related disclosures. Apologies for all the acronyms, but there'll be a few more coming down the line. So how is IFRS relevant? ISSB is a standard-setting body that was established in 2021 under the IFRS Foundation, whose mandate is the creation and development of sustainability-related financial reporting standards to meet the investors' needs for sustainability reporting. In June 2023, ISSB issued its first 2 IFRS sustainability disclosure standards, IFRS S1 and S2. These are designed to provide a global baseline of sustainability-related disclosures for capital markets. So S1 provides a set of disclosure requirements to enable companies to communicate to investors about the sustainability-related risks and opportunities that they face, while S2 is designed to be used with S1 and sets out the requirements for a company to disclose information about its climate-related risks and opportunities. The GRESB real estate assessment is very well aligned with the industry-based metrics required by the ISSB's S2 for real estate. In fact, the industry-based metrics for real estate were quite literally modelled on the GRESB real estate assessment. All public and private companies can apply IFRS S1 and S2, but ISSB cannot mandate their application. However, jurisdictional authorities can decide whether companies apply them. So while Lisa will go into more detail on the New Zealand standards, it is worth noting that the External Reporting Board, New Zealand, did release a comparison document between the New Zealand standards and IFRS S1 and S2. They found that there is overall a strong degree of alignment in the core content. However, there are many differences in the detail. It's worth noting that there have also been some criticisms of the standards, especially related to the fact that they use single materiality, which only looks inwards regarding the impacts of ESG risks and opportunities on an organisation, rather than double materiality, which also looks outwards at the organisation's impact on the climate and environment. Just taking a quick look at progress globally. At COP28, 400 organisations from 64 jurisdictions committed to advancing the adoption of ISSB globally. Some GRESB investor members, such as APG, Norges Bank and Cbus Super, were on the list, as well as the Chartered Accountants for Australia and New Zealand. Policymakers from countries such as Australia, China, Singapore, and the UK are set to adopt disclosure rules based on ISSB, while other jurisdictions, such as the EU, developed their own mandates, but have pledged to work on interoperability guidance to help navigate between the standards and indicate any incremental disclosures that are required. Nevertheless, unfortunately, the alphabet soup of disclosures and standards only continues to get thicker. So after that quick summary of the global landscape, I'm delighted to introduce Lisa Hinde to talk more about the standards. Lisa is Head of Sustainability at Precinct Properties and is responsible for implementing the ESG strategy for the business. She is a NABERS NZ assessor, Green Star accredited professional, and WELL accredited professional. Prior to moving to New Zealand 8 months ago, she was Head of Sustainability at Colliers, working across APAC to guide, interpret, and apply the growing repertoire of ESG systems and frameworks, including GRESB. So over to you, Lisa.
Good afternoon, everyone. I'd just like to start by wishing everyone who's a GRESB reporting fund a happy opening season. If you're like us, we're definitely keen to see our scores increase this year. So wishing you well in the current reporting period. I think after this session, there's very little that we'll be doing between now and end of June, except focusing on that reporting. So thanks to the team, and hopefully that doesn't disadvantage me in saying that. So here's Precinct Properties. So we're a specialist city centre real estate investment company with operations in Auckland and Wellington. So we're NZX listed with the majority of shareholders in New Zealand. We're focused on sustainability and creating communities with a long-term view, which is why GRESB has always aligned with our view on how we measure and report our progress. And we design, develop, own and manage and do this alongside partners, including iwi, our occupiers, funders and community. So we take this role very seriously. So with that seriousness comes the measuring and proactively reducing our carbon impacts, and now also under the new standards, managing climate-related impacts for key material areas of our business. So notable commitments that we've made, just to give some context to those commitments. So we're the first and only Kiwi property company to commit to the World Green Building Council Net Zero Buildings Commitment. So that includes targeting a 5-star minimum Green Star rating for all new developments, calculating and offsetting embodied carbon emissions from our developments, so essentially running an internal carbon price. In an operational sense, where feasible, we're targeting our existing portfolio to achieve at least a 4-star NABERS NZ energy-based building rating. We've also recently committed to setting a science-based target, which is really good, and we're obviously reporting annually to GRESB. So goes without saying, being on this call is very important to us. And under the new New Zealand climate standards, we're considered a reporting entity eligible to include mandatory climate-related disclosures in our annual reporting from this year. So alongside a number of our peers, we're doing this for the first time in a mandatory sense, but we have been reporting using the TCFD framework for a number of years before that. So our end of year reporting period is 30 June. So we have until end of October to lodge our first climate statement. And as mentioned previously, the New Zealand climate standards are modelled off the Task Force on Climate-Related Financial Disclosures. So understanding this global initiative was developed with the very same principles in mind to ensure a consistent financial risk disclosure opportunity for companies to provide. And I think the key word there is consistency, and tailoring that messaging to the appropriate audience, including investors, lenders, insurers, and other stakeholders. So we're aiming to engage in that more prevalently, particularly to improve transparency and ensure that we're enabling informed decision-making regarding climate-related risks and opportunities. So I'll give a very, very brief overview of the 3 standards that make up the New Zealand climate standards. So the first standard is set up in 4 sections, so kind of the same way as TCFD. So it provides a structured framework across the 4 key areas of governance, strategy, risk management, metrics/targets. Number 2, so NZCS2, provides the context around specific adoption provisions, detailing how entities are exempt on first-time adoption. And then number 3 is further context on general requirements, so providing entities further information on elements such as materiality, considerations, and assumptions. So we're very excited to see how GRESB continues to support industry under the previous TCFD reporting obligations, but how they adapt to mandatory reporting using local regulation, but also looking at how the new ISSB standards play out in the broader ESG context. So I'll pass over to the panel now, I believe.
Yes. Thank you so much for that, Lisa. That was great. So I'm very excited now to introduce our panelists. A reminder that we will be taking questions. So if you have any, I'll be keeping one eye out on the chat and I'll try to introduce what I can. So you've already met Ruben, who is our head of Asia Pacific, always struggle to say that, for GRESB. So delighted to have Ruben back joining us. In addition, I'm excited to introduce Kate Gunthorp, who is a director in the ESG advisory team at Westpac, New Zealand. Their team's purpose is to support Westpac's customers in the transition to a lower emissions and more sustainable economy. And she's passionate about helping businesses to understand the opportunities inherent in that. Kate has over 15 years experience in banking and finance, previously as a banking and finance lawyer, and more recently in sustainable finance and ESG. She is also on the board of trustees of EcoChoice Aotearoa, New Zealand's only Type 1 eco-label. Welcome, Kate. And in addition, we have Bobby Shen, who is the senior manager at the NZGBC, looking at existing buildings. This includes the rating tools Green Star Performance, Neighbours NZ, and Net Zero Buildings. He has a background in commercial architecture, sustainability, governance, and community development. In his role, he assists the property sector to drive low carbon and ESG responsive properties. Thank you all for joining us today. So maybe we can begin with you, Kate, if you don't mind. What do you see as the benefits to all real estate companies, not just ones captured by the mandatory reporting of the standards, and really what can companies take from them?
Thanks, Sarah. Kia ora koutou. My name's Kate, as Sarah said. I work in a frontline team at Westpac called ESG Advisory. So we're really out supporting our customers to transition to a low emissions economy. And part of that involves being all over and increasingly involved in climate related disclosures, both from a Westpac New Zealand perspective, but also from our looking at our customers' climate related disclosures and their transition plans. And I think when you kind of take a step back and you look at the XRB climate standards, what they really do is provide a cohesive, logical framework for thinking about longer term, more strategic and very significant risks posed by climate change. So whether you're bound by the standards or not, they provide a useful framework for understanding how your company will respond to the novel and systemic risks posed. I mean, essentially, if you kind of think about it, it's really risk management 101. So if you were dealing with any other emerging risk as a business, you'd probably want to have a think about the processes that you've got in place to manage that risk. What's your strategy? Do you need to track the risk? Do you need particular metrics and targets in place? What sort of governance structure do you have in place? And I think the other major benefit is the standards require the companies to think about different versions of the future in a more structured way. And by the way, some of those versions of the future are really, really bad. And that's where we're heading right now unless we take evasive action. So it's really crucial for more than just mandatory reporting companies to have a go. And I think there are huge benefits in doing so beyond just recognizing those risks. I think if you have a go and you have a look at what those potential scenarios are, and you can look to the sector-specific scenarios that have been published, then you're more likely to be able to lean into the opportunities that are present through the transition as well, which might be things like considering new markets or how new technologies can play a role in your business, or how you're going to meet tomorrow's consumer demands and requirements. So by doing that, you're really getting ahead of lender and other stakeholder expectations and thinking about things on a much deeper level.
Yeah, and I might hop in there as well. Kate, you touched upon the climate scenarios, and NZGBC worked with the industry and stakeholders related to the TCFD reporting to create some standardized climate scenarios to create that consistency of measurement. Because before it was like it felt like everybody had to create their own scenarios. Well, that's not the case, because it should be kind of common between us. Science should be common between us. And so there is a report on the NZGBC website to help guide any property industry. I mean, it's freely available to anyone, and the result of a lot of work working with a technical consultant to kind of chew through what does different climate scenarios mean. As Kate said, the bad ones like the hothouse scenario, what does a 1.5 transition look like? So those are kind of available as a resource, to help people not get lost in all of this, because it's supposed to be useful. It's supposed to be risk management 101. It shouldn't be something overly onerous.
Yeah, and I think that when you talk about climate scenarios, people kind of can get a bit freaked out and you think, oh God, what is a climate scenario? But really, these are just possible versions of the future. And I think it's about getting senior leaders from your business in a room, sitting around the table, reading through those sector-specific scenarios and thinking, actually, how would my business model cope in this scenario? And I think the other thing that's really relevant to call out is obviously that banks are climate reporting entities too. And these, mandatory reporting requirements apply to us as well. And so that has all of the banks thinking on a much deeper level about physical risks to our property portfolios, in particular, flooding, extreme weather events, sea level rise. And I'd say right now, all of the banks are in a bit of a race to get the best data and to properly integrate that into our systems. And once we have that data and it is fully integrated, you're going to find banks are much more savvy at making these lending decisions. And I think it's really important for real asset companies that you want to be ahead of that game. I think you want to make sure you've got more data than your bank does on your properties.
No, that's really interesting. And I think, as you say, the banks need the data. So there's obviously a flow-on effect from these mandatory disclosures. I'm wondering, Bobby, if you might be able to talk a bit more to that, what some of those flow-on effects might be from the mandatory disclosures to other parts of the market.
Yeah, for sure. There's a lot more happening in the data space that, the value of data can't be underestimated to understand the sort of the situation that property portfolios, the industry in general are in. And so we've been working a lot with ECA, who are very interested in data and shifting the industry along that decarbonisation pathway. We're also seeing a lot more people look at buildings and property portfolios in terms of the lifespan of a building. So not only just the design and construction element of a new construction, but also some of those existing buildings, which there are plenty with, there's so many of them out there that could do with some work, with a little bit of scrutiny, and to think about in a climate lens. So I think it's spurred a lot of positive change in that sense, to understand what we're dealing with, and then also start to use that data in this reporting as well. It's also kind of gotten people to look at their scope 3 emissions, starting to look at their value chain. And so, you know, for me, that's kind of a relational piece as well. Seeing who are you kind of buying into, who is supplying things for you or building for you. And so, you know, there's that switch for the whole lifespan of the building. What are those associated emissions and effects as well?
A question for your market, Bobby. What are the challenges? Because when we talk about data collection, especially tenant data, scope 3, where as a landlord you do not have control, how are let's say your constituents coping with that challenge or perhaps even limitation?
Yeah, like data is not always readily available. So there's a lot of work on metering, trying to get buildings to be up to scratch so that they can use tools like Neighbours. Neighbours is a tool that we've adapted from Australia. It's got a very strict regime on what you need to measure so that landlords can understand their buildings on the bits that they provide, or they might look at the tenant piece as well. There's a lot of, say, in the industrial sector, I've been working with the warehousing sector to look at how they liaise with their tenants. Firstly, to explain to the tenants why they're collecting their data. You know, it's not for any other purpose than to understand how the building's operating, what could be improved, and what those associated emissions might look like.
Great, thanks, Bobby. So see, we've gone down the funnel a bit to scope 3, but I'm wondering, maybe Kate, you can start with this one. How should people be considering mandatory disclosures beyond simply emissions reductions? Are there other things considering?
Absolutely. I think this is such an important point to cover off, and I know it's something the XRB here in New Zealand is really focused on. I think as a company, and I'm sure we did the same, you know, you start with emissions reduction because in some ways that's a lot more tangible and a little bit easier to grasp. And you kind of go, okay, we need to reduce our emissions. It needs to be science aligned, Paris aligned, set a 2030 target, make a plan. But I think there is so much more that goes into transition planning, which is what really sits behind the mandatory disclosure regime, than just reducing emissions. I think we really need to start thinking about climate change as a systemic risk. So it poses a risk to the entire system that we live in. It poses a risk to all business types, including us. And there will be massive changes in the economy that we all operate in over the coming years and decades. And responding to that level of risk with that same kind of linear set a target, make a plan approach doesn't necessarily work. And I think this is really when we start to get into this transition planning space. And unfortunately, we're still waiting for XRB guidance on this, but there is some guidance from the likes of the Transition Plan Task Force in the UK. That is really focused on the bigger picture and thinking about your business model and your strategy. And I find one kind of useful way to do that is to think about your foundational assumptions. So what are the assumptions that are outside of your business's control that are how you make money? So for the real estate sector, there's lots of money tied up in big things that can't be moved. They're long-term assets. So have a think about things like what are you relying on for those properties and for those assets to continue to generate a return for you? And it might be, for example, a general reliance on property market staying stable and or increasing over time. And we are going to see climate change challenging that. There will be pieces of land and properties that won't be able to be used and that will be subject to managed retreat. So how is that impacting your portfolio? I think the other consideration from a kind of business model and strategies perspective is climate change redefining what premium looks like from a tenant's perspective. So, you know, premium might have looked like a certain thing before climate change, but it is going to increasingly mean, you know, a good location that is not subject to flooding or extreme weather, a building that's resilient and low emissions, and ultimately that means low cost for that tenant. And the premium tenants are likely going to move to pay more for those buildings that meet those standards and move away from those that are not. And that's when you get that stranded asset issue. So yeah, to summarize, there is so much more than just emissions reduction to the climate standards. And I think it can be really challenging for companies because it feels like so much. And so I think it's just really important for everyone to kind of take a staged approach to this. And, you know, everyone's approach, including Westpac's, is going to mature over time, the more and more that we engage with these standards and the guidance documents as they come out.
Yeah, it reminds me of when the TCFD framework came out with its recommendations or initiative. And the recommendations, there was some basic guidance, but again, it was not sector specific. And also, as you said, well, like, yeah, how do you go about when you need to do scenario analysis? What kind of assumptions do you make, and how does it flow through to, you know, understanding the outcomes or having comprehensive and comparable outcomes even? And at that time, we saw many GRESB participants knocking on the door, like, GRESB, can't you come up with guidance on how to best do this? But again, it's about understanding as we go what the best approaches are. There's no cookie-cut way to it should be done. I think there's a bit of trial and error involved as well. But as we have better understanding of climate risks and scenario analysis and so on, and also seeing how it relates to the outcomes in terms of, you know, your portfolio becoming more resilient to physical risk, climate risk, and again, what it means financially, I think that's where we were able to identify leadership and best practices, and then show the rest of the market, look, this is what the leaders are doing. The capital providers understand that that is comprehensive, comparable information that they can use for their investment decision. So as such, provide an investor or lender lens on what you should do in terms of, you know, guidance, rather than us proclaiming that we have the know-how ourselves, which we obviously don't, but many of our stakeholders, yeah, truly want to take the lead and have shown leadership. And by us being able to recognize that and then convey that to the rest of the industry that might still be searching for the best approach around climate risk identification, assessment, and management, I think that's a very strong way of helping the entire industry understand climate risk exposure and then preventing adverse impact by building more resilience within their organizations and portfolios.
Bobby, is there anything you'd like to add about transition risk from the NZGBC perspective?
Yeah, I think it is going beyond emissions now, isn't it? And people are starting to think a lot more about kind of the S and ESG. They're starting to think about nature as well. And that was a big topic of conversation recently at the Transform conference at GBCA in Australia. I think people are starting to wrap their heads around that you kind of need to consider things holistically, and that this is going to affect people on many different levels, as opposed to just kind of being reactionary to what's coming. And there's lots of really great co-benefits that come with this as well. And I think people are starting to appreciate that about the transition, rather than seeing it as, oh, this is one big chore that we have to all do together. And the reporting as well, they're starting to see, actually, I can derive value from this process, that this process, the GRESB survey, Green Star performance, neighbours, whatever it is that they're doing well, even, then they can start to use that as a crux to, what I've heard from clients is draw their teams together, draw the people together to come around this massive task that we're supposed to be all doing. So yeah, no, I think there's some real merit to kind of thinking about it in that stewardship approach type way.
I absolutely agree with that, Bobby. I think you know, one of the main parts of my job is reading climate disclosures and then talking to our customers about them. And I'm really seeing a difference in approach in terms of the kind of do the minimum tick the box compliance, and then really leaning into the process and getting all parts of your business involved, you know, strategy, risk management, getting everyone together in a room. And that, I think, is where the value lies in this. It's really, if you do this job deeply and properly, you're really going to pick up on those opportunities that I think you probably miss if you just look at it as more of a compliance exercise. And I think we all have to take that step back. And as Ruben alluded to at the beginning, you know, the ultimate aim of the climate standards being about directing capital, and consider, you know, how are we using these climate standards to ensure that our business is resilient? And that's really what it's all about.
Are you, Kate, finding that that's most people's approach, or you know, is the mandatory disclosures helping to drive that, or are you seeing more of the tick box exercise?
I mean, we've only had a handful or less of proper mandatory reports issued now. That will start to pick up pace in the coming months. So we've really only had those few companies who've got 31 December year ends. And I'm certainly not pointing at those as being tick boxy. Those were all great. I think there is a really big step up. You know, a lot of companies have been reporting on a voluntary basis for a little while, and look, we have too. And there is a really big step up from that to the mandatory disclosure. And, you know, I think, yeah, there is a perspective that this is more compliance and who is reading this, but I promise you people are reading this and they're paying attention. And it also, you know, like, look, it also helps us to understand our customers on a deeper level. So, you know, we're not sitting there reading these things to say, oh, we're going to stop lending to those guys, but we're using it to understand which of our customers are really using it as an exercise to understand their risks properly. And that really, I think, tells you something about a company's general approach to risk management.
So
Yeah, that's totally. Oh, yeah, that's totally what we've been seeing as well, and people using rating tools, which is a part of kind of as the GRESB regime or the reporting regime, as a way to kind of start to see all those different little parts and the opportunities that lie there. I think there's a lot of demystification that has to happen, and it's great that Kate, yourself and your team and our team do the same. You know, we try to interpret parts of that for people so that they understand exactly where those opportunities lie. So yeah, it's a conversation to be had. It will mature over time as well. I'm having some really great conversations with people who are spurred on by all of this kind of reporting regime and transparency in the market around this stuff.
And I think that transparency, so we keep riffing off each other, but the transparency is so important. Like, I just want to, if anyone is thinking about their disclosures and what to put in them, just be transparent. If you've got a roadblock, if you've got a challenge, if you've got an issue, if you've got a critical uncertainty that means you're not going to hit your target, or you don't know if you're going to hit your target, or you don't know how you're going to pivot this or that, I think it's really important to actually disclose that, because again, the people who are reading these disclosures are people like banks, and we do want to help. And so there might be things that you disclose, like, for example, that you need this critical piece of policy in order to be able to make a certain business model change. Like, you need, you know, the emissions reduction plan 2 that's due to come out this year to say when the end date is for installing new gas in properties, for example. That's something that we can really amplify, you know, in our discussions with government and in our own submissions through the New Zealand Banking Association. So transparency is really helpful as well.
Yeah, my question was, I fully agree, transparency is key. But of course, there's always companies that perhaps are a bit anxious about being transparent because they're just starting their green journey, or indeed, you know, still have to find out what all of this means for their strategies, operations, management of their assets, of course. So yeah, I fully understand that capital drivers, as I mentioned as well, they have a strong carrot to dangle in front of those houses that might not be directly aligned with their interest in terms of reporting, disclosures, etc. If you, perhaps we shouldn't call it a stick necessarily, but do you have any leverage to, if they're anxious to do that voluntarily, to invite them to, or to incentivize them to do so anyway? I mean, again, I won't call it necessarily a stick, but at least a strong signal that, you know, transparency also for your operations and investment decisions.
Yeah, I mean, so our Westpac's approach, so we've and this is common amongst banks both in New Zealand and internationally, we've established a framework for reviewing our customers' transition plans and their climate disclosures. And we are applying that based on a financed emissions calculation. So that's, our scope 3, category 15 for people who like to get nerdy about this stuff, emissions. Essentially, it's the scope 1 and 2 emissions of our customers. And then there's a methodology called PCAF where you work out how much of those we attribute to our own financed emissions. And so some of those companies who sit in that largest, highest financed emissions bucket are private companies who don't have mandatory disclosure obligations. And so there is a role for banks to be going out and speaking to those companies and seeking to understand their climate related risks and opportunities in the same kind of framework, even though those companies may not be reporting mandatorily. So I think companies can be expecting banks to be coming in and wanting to understand their plans, because going back to that point at the beginning, these disclosures are really based around helping companies to manage those risks and ensuring business resilience. And so as a lender, understanding risk is what we do, regardless of whether you've got a mandatory reporting obligation or not.
Yeah, and we encounter that anxiety all the time, Ruben. People going, oh, well, when we need to start telling people about this, or there's ratings that they don't want to disclose yet because they're kind of scared that it doesn't quite meet a threshold, whatever that might be at the moment. But my challenge to them is to baseline their whole property portfolio, actually get an understanding of where they sit, because that's where the real opportunity lies. So we had several clients do this where they use neighbours, for example. Some are using Green Star Performance for lots of different other building types to baseline their whole portfolio. They start to see that some buildings probably need a little bit more TLC. Others are doing really well, and that's probably something that they're already marketing and inspiring others to kind of do this positive stuff. But once you get that understanding, then there's a really powerful concept of brown to green that can kick in. And that's where the opportunity, perhaps there's some capital that is needed to upgrade these buildings, because I'd loathe to see everyone just report stuff, but not actually trying to improve anything. We want people to improve stuff. And Kate, I'd love to know your thoughts in the banking sector, if that's kind of your thoughts on brown to green, helping and assisting people to bring their buildings up to standard, because we know in Aotearoa, there's a lot of buildings that need that kind of care and attention.
Yeah, absolutely. I think we want to bring people on the journey with us. We don't want to leave customers behind. And there is so much that needs to be built and done to achieve a net zero economy. And if we do that just by building a whole lot of new stuff, then that's going to cause a whole lot of other ecological issues. So there is a massive brown to green to be done. There is a massive amount of retrofitting and updating, from both all the way from the residential space up to the higher end space in the real estate market. And we really want to support that. And I expect any of those projects that were then qualifying under green ratings would then be eligible for green lending from banks as well.
Yeah, and the mandatory reporting does help shift the dial on ESG as well, with the real estates more broadly. These are all demonstration projects, proof of concepts that people can be doing this sort of thing, like retrofitting a building really responsibly, low embodied carbon, and inspiring others as well. So, we want to start telling those stories. We want to, mandatory reporting, but also how are you getting others to do the same, or letting them know that there are different pathways to achieve this stuff.
Thank you. I'd love to kind of bounce off that and discuss a bit about, in these more challenging economic times, how can financial institutions and asset managers balance the need for those short-term financial returns with these sustainability and climate resilience aspects, which, looking at a much longer time horizon. Maybe Kate, you can kick us off. Yeah,
absolutely. It's not just a challenge, I think, for financial institutions and asset managers. It's a challenge for everyone, and most global economies at the moment are struggling. And I was in a roundtable event the other day, and various participants were talking about, in 2019, they had all of the money in the world to fund various sustainability type programs, and lots of that is being squeezed now. And look, I totally understand the reasons for that. I think what's really, really important is that we have to start talking about these as investments. These are investments, not costs. They're investments that pay a return over time, and that business case might look a little bit different for some of these sustainable investments than it would for a typical brown investment. But I think probably the risks and the downsides later on in that brown investment are not built in properly to business models today. And so even though there might be a lower upfront cost of that, I think the downstream impacts and potential losses are really underestimated. I think, an example for us and for, most of the banks, we have sustainable lending products in the market, and those are offered at a discount. That at this stage is not a discount that we can sort of recoup via RBNZ capital weighting. That's still a discussion going on. But ultimately, the way that we view that is that by offering those products, we are incentivizing good behaviors and the right behaviors and building resilience in that customer set. And so, there is a really strong argument for us that by slightly decreasing our margins now, we're actually building more resilient customers, which is protecting our lending portfolio in the future. And look, there's another kind of way to think about this as well, especially if you're a fund manager, is that most of those funds that are managed by fund managers are invested for the long term. Their retirement savings, and those investment managers and fund managers have fiduciary duties, and those duties are to act in the best interest of their beneficiaries. So if their beneficiaries' interests are long term, then those fund managers and investors need to be thinking long term as well. And I think that's really why you've seen this whole ESG and sustainability movement come from the investor base, and it's filtered down to financial institutions and to corporates generally. And I guess, a couple of ways that we see companies doing that, build that business case. So things that you can consider are, obviously, there's often times very highly reduced operating costs from sustainable investments. So you design and build a green building, it's likely to cost a lot less money to run. Plus, you've got the upside of having the ability to retain tenants in the future. Another thing that we see lots of companies do is implementing an internal price on carbon. So that can then help to, justify spending a bit more now on the basis that, any carbon emissions from their asset may have a price on them in the future. And like I said earlier, I think the thing that's really underestimated, or the assumption that we all make, is that we're going to have this long-term availability of affordable energy, and in fossil gas and oil. And I just don't think that is going to be the case. I think we really underestimate that risk, especially here in Aotearoa, New Zealand. We're at the bottom of the world, and while we have an internal gas supply, we import all of our oil, and there's no reason why, if there is a global shortage, that people will continue to provide oil to New Zealand, or if they do so, it's going to be at a massive cost. So I think, really having a good hard think about, what that business case is, and the kinds of numbers that you're putting on things will help to justify that investment in sustainable assets.
That's great. Thanks, Kate. Wonder, actually, just bouncing off that, Ruben, how do you think that asset managers and owners can use mandatory reporting to spur actual change and impact, rather than simply being a greater reporting burden or a tick box exercise, like Kate said, could be a bit of a danger?
Yeah, well, thanks. I think what I alluded to in the introduction is that indeed it is about getting a holistic view on potential risks that indeed might have adverse consequences for not just operation of your real estate infrastructure assets, but also being able to deliver returns to your investors. And as Kate mentioned, I think the concept of fiduciary duty is very important, because in the end, we're doing this in order to pay out the beneficiaries But at the same time, there are no returns on that planet. So we have to do this in conjunction with understanding how we deliver sustainable long-term returns and at the same time also deliver positive environmental, social outcomes and less negative or harmful ones and build more resilience at the same time. So that's, I would say, quite a challenge. A couple of things, perhaps, it is about understanding that this is not just an add-on that costs time. There's I think Bobby mentioned there's co-benefits to be had or double dividends from building capacity around resilience, understanding best practices around risk management and identification processes, being able to articulate that using global or local standards that allows different stakeholders to understand how you run your process, but also more importantly, understand the potential outcomes. And then I would say mostly, and again, echoing what Kate said, transparency, right? Being transparent in where you are, even if it's at the start of your journey. And let's see, we received a question from one of the online attendees in terms of how should small companies that have not looked at TCFD aligned reporting start. I would say that's it. Just start with seeing what data you currently have, where the gaps are, what it tells you about understanding potential risk exposure and impact. And again, what it means for different parts of your organization and your assets or portfolios. And then take it from there. There's no one correct way. There's many ways to do this. Yes, it takes a bit of getting familiar to those processes. Again, understanding what the leaders in the industry are doing, which is very core to what we're doing at GRESB. And we invite everyone to report to our standards variety assessment with the aim to not just acknowledge leadership, for example, in relation to climate or other material issues, but more importantly, for everyone else to understand what leadership looks like so they can adopt those practices that have been shown by their peers. And then build their journey towards resiliency, net zero, nature positive, and all the good stuff. So I would say just get started. There's no wrong way or necessarily one right way. There's multiple ways. But if you won't get started, you won't get on your way either. So I think it's important to let go of perhaps the anxiety that comes with all of this because, yeah, we understand there's a lot going on, right? But it's better to start now than to wait and pretend and extend.
Yeah, and to identify kind of what are the priorities for your properties, for the organization, for your occupants as well. I speak to people around, is it more about health and well-being and so indoor air quality, and they might kind of focus on those credits of Green Star performance, or perhaps it's about operational ways to make sure that's a good system going forward. So there's lots of frameworks, GRESB, our tools that can help guide that conversation.
That's fantastic. Thank you. I think we're just about out of time. So thank you so much, Kate, Ruben, and Bobby for your contributions. I'm just going to ask Ruben to quickly share our contact detail slides while we finish up. So we have been recording this webinar. So if you'd like to view it back or you missed certain sections of it, we'll be sending that around. And we've also got NDY who'll be putting together a detailed summary of the discussion as well. So that should be available by the end of this month in the next few weeks or so. But we're always happy to hear from you. So there's my details, Ruben's details, and also our wonderful member success team up on the screen there as well, who are there for any of our technical questions. Any of your difficult questions, send across to member success. So thank you for joining us. I'd just like to hand over to Bobby to close.
Right, and so he whakatauki tēnei aki ai ki te katoa. Here's a little proverb from Māori proverb just to kind of inspire us all. Whaia te ihi iti kahurangi. Strive for something of great value. And this whakatauki is about perseverance and endurance as we work towards our goals, which I thought was relevant for today. But here's our closing karakia to finish off this kaupapa. Kia hora te marino, kia whakapapa pounamu te moana. Hei huarahi mā tātou I te rangi nei. Aroha atu, aroha mai. Tātou ia tātou katoa. Huie tai kie. Thank you, everyone.